Hey everyone, welcome back to the channel. Today we're diving into the July 2024 economic landscape, focusing on the U.S. economy, global trends, and what these mean for the world economy, especially with the U.S. election less than 3 months away. Let's break down the key highlights and what to watch out for in the months ahead. U.S. ISM manufacturing. The manufacturing sector is contracting with a score of 46.8. This is a decline from previous months, indicating ongoing challenges in production. The drop reflects weaker demand for goods and potentially increased production costs. Companies might be scaling back, leading to reduced hiring and slower economic growth in manufacturing-heavy regions. U.S. ISM non-manufacturing. The services sector, which makes up a significant part of the U.S. economy, is expanding. A score of 51.4, up from 48.8, signals a recovery. Growth in services suggests that consumer spending is holding up, according to the report. Arts, entertainment and recreation, accommodation and food services, mining construction saw growth in July. This could be a positive sign for overall economic stability. University of Michigan Consumer Sentiment Index. Currently it is at 67.8, showing a modest increase. While there's a slight boost in consumer confidence, the level remains relatively low. This could indicate that consumers are cautious, possibly due to inflation or economic uncertainties. Building permits have decreased by 3.3%, now at 1,406. A decline in building permits suggests a cooling housing market. This could be due to higher interest rates or economic uncertainties, potentially leading to lower construction activity and related jobs. Non-farm payroll. There was a slight increase in non-farm payrolls, indicating job gains. Implications. A steady increase in jobs is good news for the economy, suggesting resilience in the labor market. However, the modest gain might reflect caution among employers. The producer price index has risen slightly, indicating inflationary pressures. Higher producer prices often lead to increased costs for consumers, which could reduce purchasing power if wages don't keep up. The Consumer Price Index shows a slight increase, further indicating inflation. Continued inflation could impact consumer spending and overall economic growth. It also keeps the pressure on the Federal Reserve to manage interest rates carefully. Retail sales remain flat at 608,460. Steady retail sales suggest that consumer spending is stable, which is crucial for economic growth. However, the lack of growth could indicate that consumers are being more cautious with their money. A slight increase in personal income reflects a positive trend for household earnings. Implications. Increased income can support consumer spending, but if inflation continues to rise, it could erode purchasing power. Car sales are up by 3.45%. Rising car sales indicate consumer confidence in making big-ticket purchases, which is a positive sign for the economy. However, this could also be influenced by pent-up demand from previous months. The trade deficit has slightly narrowed. A reduced trade deficit could mean stronger exports or weaker imports, potentially indicating a more competitive U.S. economy internationally. A significant decrease in durable goods orders, minus 7.17%. This decline suggests weakening demand for long-lasting goods, which could signal future slowdowns in production and economic activity. Global economic indicators. The economic sentiment in the EU is declining, with a score of 96.4. This reflects growing concerns over the economic outlook in Europe, possibly driven by inflation, energy costs, and geopolitical tensions. A weakening European economy can have spillover effects globally, particularly in trade. China's Purchasing Managers Index is at 49.4, indicating contraction. With manufacturing contracting, China's economy may be slowing down. This could affect global supply chains and demand for raw materials, impacting economies worldwide, including the U.S. Russia's economy is expanding, with a PMI of 53.6. Despite international sanctions and political isolation, Russia's economy shows resilience. This could be due to higher energy prices or state-driven demand. Impact of upcoming U.S. election. As the U.S. election approaches in less than 3 months, it's crucial to consider its potential economic impacts. Historically, markets can become more volatile as elections near, with investors uncertain about future policies. Depending on the outcome, there could be significant shifts in fiscal and regulatory policies affecting various sectors. Elections can influence consumer confidence. Uncertainty around policies, especially regarding taxes, healthcare, and trade, might make consumers more cautious, impacting spending and saving decisions. Businesses might delay investments or hiring decisions until there is more clarity on who will be in power and what their economic policies will be. This could slow down economic growth temporarily. In conclusion, there is a 43.4% chance that the U.S. economy will go into recession. The upcoming U.S. election adds uncertainty, potentially affecting consumer confidence and business investments. The chance of a recession in the U.S. is moderate, but could increase depending on how inflation and economic policies evolve post-election. The chances of China going into recession are moderately higher at a 47.6%. The contraction in manufacturing is a significant concern for China, a key driver of its economy. This, combined with geopolitical tensions and structural issues, puts China at a higher risk of recession. The slowdown in China could also have ripple effects globally, especially for countries reliant on Chinese demand. The EU is teetering on the edge of recession. The energy crisis, coupled with inflation and economic stagnation in major economies, makes the likelihood of a recession relatively high. By our estimates, it is at 49.3%. The situation could worsen if inflation remains high and geopolitical tensions escalate further. This may sound crazy, but the most viable investment option according to data and our estimates seems to be Russia. Despite the geopolitical challenges, Russia's economy is showing unexpected strength. For investors, this presents a potential opportunity, particularly in sectors like energy. However, the political risks remain high, and investments in Russia should be approached with caution, considering the broader geopolitical landscape. The economic landscape is complex and fluid, with the upcoming U.S. election adding an additional layer of uncertainty that could sway these probabilities in the near term. Although the situation might seem gloomy at the moment, we are here to help you navigate the stormy sea of economic uncertainty. Stay tuned, and thanks for watching. See you in the next video.